Hello everybody, this video is about startup financial phases. If you want to make money with your idea, you have to generate a working product or service to sell. It is often necessary to spend some money in the different development phases, for materials, for a website, for some services, and soon. From the idea to the product to sell, if everything works, the company has a growing value over time. The risk to fail is related to that, but the risk to fail is higher at the beginning and lowers with the startup getting stronger. If we analyze this graph in 4 different milestones, we see that risk 1 is the highest, while risk 4 is the lowest. But what about return on investments? The higher the risk to lose your money, the higher the possibility to get a high return on investment. Higher return on investments is the reason why some investors are interested even the risk is too high. We get different investor types. Some are more likely to invest on a more risky scenario, but with high return on investments, even with low amounts of money. Others prefer a less risky scenario, with lower return on investments, but maybe with higher amounts of money. The first investor type is composed by family, friends, and fools. The risk here is very high, as more than 90% of startups fail. You are experimenting, you don't have a product to sell. You are trying to validate your problem and maybe producing some prototypes. Only someone who knows you well will invest in this phase, like family and friends, and some fools that do not know you, but fall in love with your idea, and try maybe too to get a very high return on investments, even if very risky. This is a seed investment stage. The second phase is a phase where you can demonstrate that your hypothesis is correct, you have some numbers to show and you have a minimum viable product to start entering the market. The risk here is lower, but still high. Business angels and startup incubators could be interested to invest in order to start selling to the market. This can be considered still a seed and an early investment stage. The third phase is based on growing revenues, but you need money to be able to sell in a bigger market, to begin scaling. You could get higher amount of money with crowdfunding or with startup accelerators, in order to boost your business. This is the early or later investment stage. The last investment phase is the phase where you lose control of your company, but you get a very high investment. This investment is needed to become stronger and to compete worldwide. Venture capitalists are the right investors for that. They take control of the company and they guide the company to become a big competitor and to be sold to a bigger company, making a lot of money. This is the exit investment stage. Company gets a high amount of money, you lose control of your company, but often founders still work in their company, even after the exit phase, and you become rich after this phase. Do not forget that getting investments is not easy, so sometimes it could seem you are failing because you don't find investments, and the day after you get an investment, and you feel like the strongest in the world. I hope this quick tutorial was useful for you to better understand startup investment phases. Thank you for watching Simple Money Tips. We are working on other business examples. If you have questions, write them down here. If you want, leave a like or subscribe to this channel. Thank you very much.